A while back, I talked here about the new wave of buyers, particularly those focused on smaller SaaS companies, and especially those serving vertical markets. Across private equity firms, holding companies, independent sponsors, search funds, family offices, there's a huge variety of vehicles for acquiring or recapitalizing technology companies right now, and many of them are making aggressive bids. And one thing that enables those aggressive bids is the predictability of subscription revenue. Predictable revenue means financial buyers can make bigger bets on your company, and the more predictable, the bigger the bet they can justify. What that means, though, is that many of these buyers have become experts in slicing and dicing your financials to generate the key metrics they need to justify an offer. These metrics may not be the ones you expect or even have easily available, but the better grasp you have on them, the easier time you're going to have navigating this new world of buyers. We'll talk about 3 of those metrics today, and though different buyers have different approaches that they utilize, if you can get a handle on these 3, you're going to be in better shape in M&A discussions. We'll take a quick look at recurring revenue as a percentage of total revenue, net dollar retention, and gross dollar retention. Now, I should also add, this isn't just about financial buyers, and it's not just about software. 2 trends we've been talking about for a long time. Strategic buyers are behaving more like financial buyers and vice versa, and the key metrics for software companies are becoming more and more expected for services companies as well. So, recurring revenue, as noted, is the key that unlocks a lot of this potential, and as such, it's one of the first things buyers look at. Many tech acquirers have hard limits on how much of a company's revenue can be non-recurring or reoccurring if they're going to do a deal. 70 or 80% recurring is typical, but you'll see buyers that need a higher level or can handle less as well. Often your valuation is going to be based on a multiple of ARR, not your overall total revenue, so it's certainly important to understand. The cleaner that recurring revenue is, like a monthly SaaS subscription, the better, but a wide variety of predictable revenue types may get treated like ARR depending on the buyer. Long-term contracts, maintenance revenue, managed services, etc. Buyers may also differentiate between revenue contracted for a specific period versus revenue that is month to month. You want to be able to present all of this clearly from the outset so you don't have to claw back or discount revenue that should have been considered recurring or walk back revenue that isn't really recurring when you had said that it was. The next 2 metrics look directly at that question of predictability of revenue. For a long time, buyers looked at churn and retention in terms of customer count, but that focus on logo churn is now often secondary. Instead, buyers now look at the revenue change over time within your existing customer base. Gross revenue retention is the least forgiving of these metrics, but it's often a hard line for buyers where deals live or die. There are a few ways to do this, but typically the buyer will look at a snapshot of your recurring revenue by customer from the most recent month available and another one from 12 months before that. Gross revenue retention is calculated by looking at lost customers and customers that have reduced their spending on software with you, downsell. Now, it's not looking at upselling or land and expand. It's just built to understand how much money you are expecting to get from a customer that you aren't getting anymore. Buyers will have different perspectives on the gross retention metric that they target. Some want 90% plus, others 80%, some may go lower. Numbers below 70% can be challenging and will require careful positioning to present to buyers. Now, net revenue retention is more forgiving. This looks both at the gains and the losses within that recurring monthly revenue by customer. Again, buyers will look at year-over-year changes, but net retention gives you credit for increasing revenue per customer, upsell. Buyers like to see this number be over 100%, meaning that your revenue is growing fast enough within the customers you're keeping to make up for any customers that you're losing or who are cutting back. It means that your revenue will keep growing even if you didn't add a new customer, and can mean that even a lower growth company can be attractive with such a strong base to work from. Now, there are other metrics that buyers look at, but a firm command of these 3 is a great start. This is one reason we recommend choosing your partners carefully as you consider M&A. Certainly, you want an M&A advisor who understands how the buyers look at these things, but you also need your finance and accounting team to be familiar with these sorts of metrics. Not all of them are, so that's a conversation that's worth having today with whoever is responsible for your financials. The Corum team is happy to discuss your circumstances and what we're seeing in your particular part of the market. Whether your metrics are through the roof or you've seen challenges, there are remarkable opportunities for tech companies in today's M&A market. But, as we always say, the better prepared you are, the better your opportunity for an optimal outcome.